Welcome back to another episode of the Anatomy of the Trade. Today we're going to go through the currency updates, and usually we only look at the majors, the pound and the euro against the dollar. We don't even look at other major currencies, but just to kind of like have a look, discuss the structure, and maybe to bring some value and pointers to you guys who are trading currencies. So we're going to actually look at the big picture. This is the pound and the euro against the dollar. And this is one weekly chart. So this is not necessarily what you guys, that are extremely active on the intraday basis, maybe even on the short-term swing basis, look at. But we want to bring your attention to the long-term structure that is unfolding and the consequences of that structure. So, Franz, let me ask you this question right off the bat. So what do you think the bias is for the pound and the euro based on what we see here?
Well, Roman, and hello everybody. We basically have 13 years of a strengthening dollar versus both the pound and the euro, and the kind of the nadir of this move is for the euro in 2015. So we're talking 5 years, 6 years. For the pound, it's 2017. So again, 4 years. And there really hasn't been any, obviously we were in a bull market for the dollar, a bear market for both of these currencies relative to the dollar for an extended period. But the question now is we're really not making any further downside progress. So to answer your question, the bias currently, potentially, we're in a point where the bias could be changing from this extended bear market in both these currencies relative to the dollar to something, something different. So that's what I'm seeing. What do you think?
Yeah, the way how just this formation right here, this trading range right here, it looks different than what we've seen before, right? Because we always have to compare the structures and we have to find those distinctions that are going to tell us whether there is more buying or selling behind the new structures relative to what we've seen before. So, and by the way, let me just give you one technique, one tool. This tool was developed by our practicum students, and we call this in the classroom a flashcard. A flashcard is just a collection of main ideas about the bias. So sometimes you go into the analysis and you just basically overanalyze. You stay with the charts for too long, and then you find both, you find the evidence for both cases, for bearish and for bullish case, and it just misleads you. So the flashcard tool, and the whole idea that you just take main ideas and you just concentrate on those, and usually those are going to be the most important ideas. It's going to be very, very simple. So let me show you. So the flashcard number one, when we're comparing these two trading ranges, so let's say area number one to area number two, area number one to area number two, what do you guys see? And is there distinction? Is there difference between these two areas? And most definitely there is, and it's actually quite substantial. First of all, when we look at, let's say, euro, and we're looking at the volatility of the swings of the first structure relative to volatility of the swings of the second structure, we're going to say that volatility actually diminished, and diminished significantly. So this is a bullish sign that shows that there is less selling. Okay, so secondly, and Franz, I'm going to ask you, what's your flashcard here as well, idea. But secondly, what I see in those structures is that as we go through the whole structure, look at the composition or the texture of the movements up and down. For instance, in euro, we're seeing the rally in the middle of the trading range that exceeds the resistance of that range, and then it goes down. We did not have anything like this here. There was an attempt to upthrust and it quickly failed. There was no consistency of staying above the resistance, which again shows some buying and capacity to uh, keep the price above the resistance. That's a very important concept. Now here we are kind of seeing the same thing here with the pound at the same locality. So that's your second flashcard. So the bullish behavior of the trading range. And with that, we also, would look at the reactions and look how laborious that reaction is. And that suggests again that the selling is not that aggressive. Okay, Franz, so flashcard number 3. What else do you see on this chart?
Well, I do see that in both cases where the previous resistance, which was previously support, was broken, obviously that's a clear area that needs to be overcome in order for this bullish to clearly be changing from bearish to bullish. But what we're seeing is, instead of, which was sort of the case with the previous 2 extended trading ranges, later in the trading range we see kind of classic phase C behavior of distribution, where you're making lower lows, you've got last point of supply, you've got just basically supply overwhelming demand. Here it looks different to me. So particularly in these last rallies, this last swing, and we should probably compare the swing to swing. So I guess that would be my flashcard number 3, comparing there are 2 major swings in this current trading range that we're in. So I'd look at that first, and then I'd also compare that swing to the swings in the previous trading range. But let's look at this first one, the first area first. The first swing, it's somewhat labored. It does start it with the pound, for example. Yeah, that one starting in 2017. It does carry us back up to the resistance, but it's somewhat labored. It's got a lot of supply coming in on the way up. You can see a lot of little reactions along the way, and then finally we make an upthrust and pull back down into the range. Where we are now, the way this last swing is developing, very interesting, because if you look at about the period of the COVID collapse with the pound, and you see this, this kind of, very obvious 2 weekly bars of significant liquidation, that immediately, you get the resurrection effect, and very apparent kind of phase C behavior in accumulation.
Yeah, I'll take that as a flashcard. So let's just say let's put this as a sprint structure. So sprint structure is where the price commits below the support temporarily and then almost immediately recovers back. So it's an opposite of an upthrust. And then please note that the euro actually had that type of volatility, but never made the lower low. So we'll talk about this. Okay, so sprint structure. Okay, great. Now let's expand a little bit the whole view. We kind of, just look at maybe like this. Well, actually, no. Let's come back really quick. There are a couple more points here that we could make before we go to something else. So this looks like it's playing out as a potential accumulation, this whole range. So a couple of ideas here for you who are traders of the currency markets. Whenever we look at the long-term trading range and look how many years we have here, 5 years, this is a big course. And this suggests that the effect of this course is going to take some time. So the uptrend that we're expecting, to be here might continue for some time. And right away you have to start thinking, okay, well, if it's going to continue for some time, what are my targets? Well, your targets are going to be, all of the lines of resistance that, is being observed on the long-term chart. So here it is for the euro. So these are your very, very high targets. If you were told that, within, a year or two or so, the price will come here to, let's say, 1.5, how would you trade? What would be your behavior? So you have to think about this. And the same for the pound. So you just want to identify roughly, what are those long-term targets, and then just based on the relative performance, just say what targets are reachable here, what is most probable to happen. Obviously, target 1 is more probable than target 2, but you still go with the long-term causality, and the idea that the effect might take some place. Okay, let's go into some of the details here of this trading range. And as Franz started, this idea, this conversation about structure of this trading range. Well, there are two interesting spots here that define the boundaries of the trading range. And by the way, please note that we do not use volume signature. I'm a little bit cautious about the volume in Forex, as when I traded Forex, it always has been a question like, what is the correct volume signature? So I don't want to mislead you here. But we could read the volume expansion of the price chart. How do we do this? So for instance, when the spread is increasing, we know that these are the spots where the participation was immense. And it was very, very active participation by currency traders. So therefore, the volume signature had some kind of volume spikes. So we have volume spikes on the way into the trading range, and then we have volume spikes on the way out of the trading range. Usually those type of events would identify the boundaries of the trading range, which is, very nice. And plus, what Franz has said about the spring, where we are committing to the downside and then we're quickly recovering. This is a very, very bullish pattern. And we're clearly in the uptrend since then. Okay, Franz, well, let's just say that if we are anticipating that this is a phase C, what should happen next structurally? What do you think?
Yeah, the next event is a sign of strength as defined by the ability of price to move up through previous levels of resistance and maintain themselves for some period of time in a commitment in that new zone of supply and demand equilibrium.
Mm-hmm. Yeah, and I would be saying, I would be thinking here, where would this sign of strength rally go? So, I mean, obviously, characteristically, we have a really good rally, especially in euro. Look at how momentum is coming in after a volatility event. And we are traveling really freely with a lot of ease of movement. Why? Well, the selling here was somewhat depressed. But there was no buying. But once the buying came, and it came here on the liquidation of all of the assets in the COVID reaction, that's when they got into this position, and that's why it moved so much. Now, please note how here we're already losing momentum. And I'm thinking that this was the target here, 125. And this is a pretty big move, for the currency in 1 year. Um, 20 full figures here almost.
Definitely,
Um,
definitely.
so right here, this high, it was associated with the beginning of the climactic run selling. And this is a very important spot because usually we would need to overcome it. For the pound, the same thing. This is where the selling was the most active. So my argument for the pound is that it actually might go into the zone, whereas the euro might, bounce up, maybe have an upthrust, and then start going into the backing up action. And that's the backing up action, actually, guys, that we would be waiting for as the next major opportunity to consider entering the position, which is the long-term position. And the backup action might take some time. It might have the shape and the form of the trading range. But why am I saying the pound? Well, just most recently, look at the price action that is happening. And we're seeing that the pound is still being vertically observed. There is some selling and then recovery, selling and recovery, selling and recovery. Whereas in the euro, you kind of see this reaction and exhaustion of the momentum. So I think that maybe for the short term, there might be some outperformance by the pound. And that is also very logical because as the major big currency traders look at these two assets, they're probably thinking the euro is somewhat overextended short term, and then the pound is slightly behind. So there is a little bit more value in the pound, and that's what's pushing the price higher and outperformance. So that's why I'm thinking that maybe like it's this zone right here where the pound can go, and euro still could, have a major resistance at 125. Okay, Franz, what else could we say about the structure and, maybe the bias itself?
Yeah, I mean, it's so interesting, Roman, because we're really talking about issues just that extend beyond just currency trading. We're talking about, supply and demand of dollars, which represent the strength of the United States economy, to euro, and which is obviously the continent, and the pound. And it's interesting to me to think, and it's really not a topic for our discussion here, but to think about what that necessarily might mean just for our overall economy going forward. But as far as the bias, if this is indeed an accumulation pattern, which it certainly looks like, although we do have that area of, we've got that area that we've got to overcome first and show the ability of, the exchange rate to maintain itself there, and, to hold. If that's the case, then, these upside targets that you've, previously discussed, they lay out a very interesting, picture for, currency trading.
Mm-hmm.
And
Yeah.
if we are indeed in a change here, if we're emerging from this very, very large cause into a different environment, into an uptrending environment in both of these currencies relative to the dollar, it's creates a lot of opportunities.
Mm-hmm. Well, let's go through this again really quickly. I mean, like, what are the main points here? Like, how could you read the chart without the volume signature? And I've shown to you some comparisons, of this area to the previous areas, previous big trading range, and the difference is there. You could just like extract the bias from that. We've talked about this major downtrend, so it concludes with the stopping action, which is different for both of these currencies. So this is stopping action, and then I think that the kind of like the big clue after the stopping action was this rally right here.
Mm-hmm.
And only because the pound is weaker, this becomes a little bit more laborious. And the euro is just showing not only the bias here to the upside, but it also shows that in the future it's going to outperform. And it's very interesting. One might say, like, well, you're looking at this in a hindsight. Well, yeah, of course, I'm not trading the market, this particular markets right now, but my analysis in real time is going to be the same. And my analysis is always based on the belief. And this is almost like a religious belief. If you could adopt that belief, it will move you with much faster speed in your analysis, and that belief is, let me take another color and make it dramatic here. Judge the market by its own action. And no, this is not mine. This is by R.D. Wyckoff. And what does it mean? I mean, you know how sometimes the most obvious things that are being told to us in life, and you kind of like, yes, I totally get this. And nothing comes to my mind right now. Maybe Franz, you know, if you can come up with like the most common thing. You know, it's only when we experience it and we kind of go through trials and tribulations of that statement, we could really internalize what it means. And then it becomes almost like a religious thought where you're possessed by this. So this is where I am with this statement: judge the market by its own action. I truly, truly believe, and I don't think that, you know, anybody could present the evidence otherwise to me, that if you look at the past of this structure, how it unfolds, it will show you what's going to happen next, or at least it could give you some kind of good idea for the bias, good idea for the timing, and even good idea for the character with the price is going to move. So this rally right here, because euro is outperforming on this rally the pound, so it shows more buying. The stopping action has happened much faster, so that also suggests that there is more buying in euro than in the British pound, that the pound is going to be weaker, that we might have a lower low here when liquidity comes. And we know that the liquidity is going to increase here. And again, judge the market by its own action. Why would we say this? How could we predict this? Well, when we look at this whole reaction, look at how there is, you know, exhaustion of selling that is happening here in both cases. So with that exhaustion, there is anticipation that at some point the market is going to be much more interesting when market participants are coming and adding some liquidity. They are buying and selling with, you know, a much more frequent rate, and that would define the timing as well. And look how nicely that defines the low for us. You know, that whole idea. And from here, we already know that the bias is bullish. There is a potential outperformance by the euro, and that's happening exactly this way. And now we just mentioned more short-term situations where there is some rotation between these two currencies on the relative comparative basis. All right. Well, Franz, your last thoughts, last comments?
Yeah, well, one question for you, Roman. As we look at this significant area, the final capitulation area in both of these currencies, and as we evaluate that as the area that we really do need to overcome for this truly to become actually an accumulation pattern. While we're going through this, and before we get to that, there's always the possibility that we're not going to be able to, the markets, the supply and demand isn't going to be able to overcome those areas, and that we're going to be back in this trading range again. So I guess my question is always, until we actually see the evidence, until we see the commitment, we really, we can have a probability of something happening based on what's gone before, but we don't know for sure.
Yeah, so I guess the question, and maybe this is what you're asking, Franz, is what do we do, right? How do we trade it?
Yeah.
So, for instance, imagine, guys, that you don't have any positions. I mean, like, your analysis is showing the bias, your analysis has shown that the timing, for this rally is now, what should happen? Well, as Wyckoffans, we would look at the structure and assess the potentiality of a specific trade, whether this is an intraday trade or a swing trade or a long-term trade. So obviously a long-term trade is not that favorable right now. And by long trade, I mean long-term trade, campaign trade. So what would we, potentially have here as a trade? I think a swing trade is possible if we're thinking about the sign of strength rally, if we're thinking about this resistance. So you still have quite a lot of room here for a swing. Definitely intraday, where you're intraday trading with the upward bias into the resistance. That's a possibility. And then once the price gets here, this is where, again, you're going to make that judgment call as to, is this a sign of strength rally? Is this characteristically, having some supply issues or problems? And you will have to compare it to the previous instance where at the same price level, the price has stopped. And we clearly see that supply has come in. So there was some selling at this point. And that's very logical because the selling has come here before. So this is what you're going to be working with at this point. So tactics are going to be based both on our understanding of the bias and our understanding of where we are in the structure. And if we would be closer to the low when we were commenting action right here, we were commenting on the long-term campaign trade. And hopefully, guys, you saw those videos and you kind of benefited from this. I mean, this was a really good call, Franz, back at that time. So that was great. Okay, well, with this, here is our update of the currencies. Thank you so much for watching. And, we will be updating you on the currencies from time to time, maybe like once a month, or maybe once in 2 months. But this is definitely also a very interesting market and markets to observe. Thank you so much for watching.
Great discussion, Roman. Thanks very much for showing us what's going on.